Hey, what's going on, my friends? It's your man Adam Ace Spencer here with a look at our growth portfolio where we contribute $25 a week using the cost averaging investing strategy, which I actually just made a video on dollar cost averaging yesterday. And feel free to check out that video. I will add a link to that above my head in the top right hand corner. And ultimately, that helps explain this investing strategy and why I'm not worried about our growth portfolio being down 33%. After all, this is a growth portfolio, and oftentimes, more often than not, there is going to be a lot of volatility, and it will tend to be in the red or down at first. And it's part of the territory. Like I said, with great risk comes great reward. These growth companies haven't entirely proven themselves in terms of where they'll be in 5 years, or how reliable they'll be in 10 years and whatnot, if they'll even be around then. So we're taking that risk and investing in these companies because we believe they will be around in years to come and that they'll be bigger and more successful than what they currently are today. So that said, let's jump into our portfolio, because you can see over the past day, we are down 0.33%. Over the past week, we're down 6.82%. Over the past month, we're down 24.52%. In the past quarter, down 32.55%. The past year, all time, we are down 33.77%. We started this portfolio back on October 8th, and we had immediate success out the gate because of one or two companies in particular that pretty much we bought them at the right time and they ran it. But because of the way all these SPACs have developed over the past year and how they've played out, pretty much they've ran up and then they would kind of tank down. And with that, you kind of see a lot of our other growth companies also getting hit pretty bad. I pulled up a few articles here, one of which dives into DraftKings in particular. And that's what we're going to dive into in this video, DraftKings, because, the growth market in general is kind of beat down. Our portfolio is no different. And when we look and see who is doing well, who's, not so hot, you can see Nvidia is up at the top of our list, holding us up, barely holding us up. We would be down even more if it wasn't for Nvidia, who's up 20.98%. And then we have ChargePoint inside of our EV pie, which is negative 24%, followed by Coinbase, negative 25%. Then we have Palantir, negative 36.68%. Then Backed Holdings, down 37.46%. Fuel Cell Energy down 47.17%, and then DraftKings is down 52.39%. Insane. And like I said, I pulled up a few articles that are going to dive into a little bit more about DraftKings and why I'm not worried about them and our portfolio in general. Now, I've said it before, I'll say it again. For one, we at most we don't want to have more than 10 companies or holdings in this portfolio. So right now we do have space for 3 more companies that we can add to this pie. But secondly, Fuel Cell is someone that I'm still kind of like, I'm questioning the most. There's some potential red flags there. So I do question Fuel Cell, but no one else in here I'm really worried about. Everyone else, I'm confident. I feel fine. Backed might be someone you would potentially question, but I like Backed a lot. I think what they're trying to do is unique and logical. It makes sense. Why can't we just use one app that manages all these kind of digital currency type of assets? So I think what they have in mind is on point. I don't know if it's just an execution, if it's just a marketing, or why that hasn't panned out. But at the same time, it is connected to crypto, which I think any companies that are really tied to crypto have taken a hit, similar to what you see up here with Coinbase. So I'm not really worried with Backed either. All of that said, we do have space, like I said, to potentially add 2 or 3 more companies to this pie. I do have one or two ideas as to who I might want to add in the mix, but I'm open to suggestions that you guys might have. Feel free to leave a comment down below with, a good growth company that you're like, you know what, someone that's unique from everyone else in here that has a really great potential. Let me know. Comment down below, my friends, because I definitely am open to suggestions. But that said, I want to dive into DraftKings because they are down the most, which is surprising. But it might not be to some people. They if we dive in here, you can see stay clear betting on DraftKings stock until its dilutive deal is done and profits appear. This came out 20 hours ago. And as you can see, DraftKings has been in a free fall since peaking on September 9th at $63.67 per share as of January 13th, down to $24.24 per share. This means that DraftKings stock is below the price of $27.47 where it closed at the end of 2021. So, moreover, since all-time peak during 2021, closing at 71.98 on March 19th, DraftKings is now down 66%. That means it has lost 2/3 of its value in the past 9 months. Something is wrong here. As I've written before, I think it's because the market does not like the company's ongoing losses and its potentially dilutive acquisition deal. Now, a lot of this really just dives into them spending money. And ultimately, when you are a growth company, you have to invest in your business and other potential opportunities out there that align with where you can take your business. Don't forget these costs are on top of its gambling overhead and other costs. Of its revenue was $170 million. To put it bluntly, DraftKings is bleeding cash. In the last 9 months, according to its cash flow statement, the company burnt through $366 million. As I wrote last month, this works out to an annual cash burn rate of $488 million. So it's a good thing that DraftKings unrestricted cash was $2.394 billion at the end of the quarter. At this rate, it can burn $500 million in cash flow each year for another 5 years or so. But once it takes on Golden Nugget Online Gaming and its losses, that cash burn will increase. For example, GNOG reported that its 9-month operating cash flow losses were $29.5 million as of September 30th. This will take the total cash burn over $500 million next year. Analysts want to start seeing some prospect of positive cash flow going forward. At a minimum, they will want to see if the GNOG acquisition eventually has the prospect of helping turn the company profitable. The good news now is that DraftKings has already provided guidance for its 2021 revenue of $1.26 billion. In addition, it has given 2022 revenue guidance of $1.7 billion to $1.9 billion. That implies a sales growth of 42.9% over the next year using the midpoint. Now, like I said, I want to show you guys both sides of the table. I don't want to just show you the good, all the roses and everything with some of these companies. So I did want to dive in here first and show you some of the kind of negative, I guess, that you will hear people argue about DraftKings. And I do think also knowing that, hey, DraftKings is a big player inside of Kathy Wood's portfolios. Now, is she going to be perfect? Is she going to be always correct? No, of course not. But as you guys can see, DraftKings specializes in sports betting and fantasy sports league, live games and casino games such as slots and blackjack. It operates in 17 countries and 18 U.S. states, among them New York, where regulators allowed the state's first group of online sports books to begin operating on January 8th. So just getting into New York. All right, the company has not limited itself to gambling. Through a recent partnership with One Team Partners and the NFL Players Association, it will launch gamified non-fungible tokens, NFTs, through the DraftKings marketplace. And I have another article that dives more into this a little bit coming up. But also in August, DraftKings announced its pending purchase of Golden Nugget Online Gaming for $1.56 billion in stock. This acquisition, which management expects will close in the current quarter, should add 5 million customers to a company that attracted a record 2.1 million monthly unique players in September. DraftKings booked $823 million in revenue in the first 9 months of 2021, up 181% year over year. Still, its expenses have also risen rapidly, pushing its losses for the period to $1.2 billion, up from just under $1 billion in the prior year period. However, DraftKings took only a $3 million loss on warrant liabilities in the first 9 months of 2021, far less than the $411 million loss on warrant liabilities it reported in the first 3 quarters of 2020. This was a huge factor in reducing the growth of its overall losses. Those negative numbers on the bottom line have weighed on the stock for most of the year, and it now trades about 65% below its 52-week high. This has also taken its price to sales ratio to 9, down from 23 as recently as September. While the company is likely years away from profitability, today's relatively discounted share price could provide an opportunity for long-term investors to profit as it expands its market and reduces the growth of its expenses. This is where, we are focused on, my friends, because we believe in DraftKings in the long term. And as this suggests, these are incredibly cheap, discounted prices that we can start to accumulate. And so we are not panicking. We're not freaking out. We are continuing to buy DraftKings. Now, one of the other things I want to point out is that legalizing online gaming is a relatively new phenomenon, and DraftKings is growing hand in hand with state approvals. Between 2017 and 2020, DraftKings increased revenue from $192 million to $615 million, and it has accelerated its revenue growth in each of those years, ending 2020 at a 90% increase. Hyper growth, to be sure. And again, as I mentioned before, one of the biggest kind of complaints is just how much they're spending money. And, this points that out as well. It makes sense, though. They are a growth company. You need to invest in, they're not trying to be profitable right now, in the sense that, yeah, they get this money. They, what are they going to just do with the money? Just sit on it and pile up their cash? No, you got to reinvest that money. They could eventually pay dividends, but they're not doing that now. No need to, because we want to see them invest the money back into the business. So we're not worried about the company spends aggressively on customer acquisition. Like we want to see them doing this now while the company is still young, while the company is still developing, and while we still see them evolving into something that will be here and part of the future, unlike anything we've seen before. So as you can see here, DraftKings stock is a terrific sports-focused metaverse investment. So hey, if you want to get some exposure to the metaverse, we're getting a little bit more here with DraftKings. We already are getting that exposure with Nvidia, but we're absolutely getting that here as well. And as you can see, prospectors, it questions, or it asks, should prospective investors consider DraftKings to be an underappreciated gem or a toxic business? It all depends on your tolerance for risk, as well as your outlook on the future of the metaverse and the non-fungible token NFT industry. Plus, DraftKings stockholders should be willing to accept DraftKings' shifting business model. Sure, DraftKings is still an esports iGaming company, but it's now evolving into the built worlds of the metaverse. If you're not on board with that, DraftKings probably won't appeal to you in 2022. Yes, I would encourage you to embrace the NFT trend instead of trying to resist it. Now it says, in DraftKings' recently released investor presentation, it's evident that this company is in transition. The shift towards the metaverse and the NFT industry is undeniable. The company has declared the early innings of DraftKings marketplace a success, and NFTs will undeniably continue to populate this tech-enhanced platform. Of course, there will often be a sports connection here. For instance, DraftKings marketplace launched with the drop of premium edition Tom Brady NFTs provided by Autograph. And that's not all about sports. However, Autograph teamed up with Lionsgate's Twisted Pictures and DraftKings to release Saw movie-themed NFTs on Marketplace. These were the first non-sports digital collectibles on the DraftKings platform, and the Saw NFTs sold out within minutes. These truly could be the early innings as DraftKings is considering the possibility of minting its own NFTs in the future. In addition, DraftKings plans to work with peer partners to help combine the excitement of football with the tech-enhanced metaverse. Reportedly, DraftKings is partnering with the NFL Players Association and One Team Partners to launch gamified NFT collections. These collections will debut on DraftKings Marketplace during the 2022 and 23 NFL season. For this purpose, DraftKings will have licensing rights for active NFL players, including the authentic use of names, images, and likenesses. Hey, this to me is all huge. It's all big, and it's something that I'm excited to be a part of. To see us have this opportunity to get access to DraftKings while the stock price is so cheap compared to where it has been. Because, like I said, had we started this portfolio a little earlier too, we would be even, things would be in a even worse position than where we currently are. But imagine all the people who bought this back on, mid-March 2021, maybe at the peak of October back in 2020, that are still holding. And those are people that believe in this company and believe in what DraftKings is doing. So am I worried about how, them being at the lowest point in our, not only like while we've owned them, but in our portfolio? I mean, down 52%. That's crazy. Not fun. And unfortunately, this is part of the journey, my friends. And I know I just said it's not fun, but it's kind of like it's intense, and it's like a rush, right? Because it's like, oh my God, I'm down so much. Like, you're freaking out, you panic, you want to sell, but you can't sell. This is a steal when it comes to being able to buy it at these prices for how low it is. So although we are down right now a lot, my friends, again, this is a growth portfolio. If you want a safer bet, if you want more reliable, predictable numbers and whatnot, check out my dividend portfolio. I'll also be making some videos soon diving into ETFs, since my Roth IRA is pretty much full of ETFs, and that's doing well. But I will throw out really quickly, my best performing portfolio is heavily kind of growth, but it's a combination, growth and value and dividends, and the whole shebang. That is doing best right now out of all my portfolios. I don't want people being discouraged that, oh, growth is horrible, especially, with this current market. Well, if we were like trying to retire now and we needed this money now, then yeah, we would be worried, and, we wouldn't want to be in growth. But the fact is, the growth sector, whole sector is down so much that this is the time to buy and hold. And if it's a company that you truly believe in, if you've done your research, just like we just dove into some articles on DraftKings, and you're looking at some of their numbers and some of the concerns that you might have as an investor, but you're looking at the pros and you're saying, okay, I believe in what they're doing, where they're investing their money, why those cons exist are logical reasons for me to say I'm okay with them being in the red there, and I'll continue to invest in them. And that's how I pretty much feel with this portfolio in general, and how you need to look at growth stocks. So if you're new to investing, I do have some links down below where you can get some free stocks, some free money, depending on which link you click. So get the ball rolling, start your portfolio, and just consider some of these companies that we have in our portfolio that you might want to start to add to your portfolio now while they are so cheap. Because remember, if I'm down this much and you start, if you get on board with them at this point, you're going to be above, you're going to be ahead of me, so to speak. And so as I continue to do well, you'll be doing even better if you were to add any of these companies after the fact, So figured I'd throw that out there right now, but want you guys to know that, yes, we are down a bit, but we're not freaking out. We're not panicking, and we're continuing to contribute $25 every week, and potentially even a larger amount, while we are seeing these steals, right? While we are seeing these discounts, because you might not potentially ever see some of these stock prices as low as they are ever again. And on that note, my friends, I gotta keep it moving, but much appreciation for watching. If you have any thoughts, any comments, feel free to leave a comment down below. And while you're down there, subscribe to the channel, my friends. Hit that notification bell so you can stay up to date on all of my latest and upcoming videos, including tomorrow's dividend portfolio update. But all right, my friends, you already know I gotta keep it moving, but much appreciation for watching, and I'll see you in the next video. Peace.